Let me throw this number at you.
Okay.
As of Q2 of this year, total credit card debt in the U.S. is $1.14 trillion. That's a record high.
Yeah.
When you hear that number as a mortgage loan originator, what comes to mind?
Responsibility. As a lender, we can help them. We can help our clients understand that we can use the tool of the equity they have in their home to help with some of their credit card debt, to get them out of the 35% interest payment into using, even if the rate's a little bit higher than what they had before, and using that to lower their total monthly expenses.
Welcome back to Good Better Broker as we welcome in Ann Sullivan. She is a loan officer with Lending Heights based in Pittsburgh. Ann, great to see you.
Great to see you. Thanks for having me.
Well, a little bit about you for our listeners who aren't familiar. You've been in the industry now for 12 years. You lead a team of 6 at Lending Heights. You were also a featured speaker at UWM Live in 2023. And in the last couple of years, you and I have talked about several different topics in the industry, and I'm not sure that there is a more important one than the topic we're about to get into, and that is leveraging equity in your home. So as we get the conversation going, let me ask you first of all, what's your overall approach to counseling your borrowers when it comes to leveraging their equity?
I think the most important thing is really communicating with the client how powerful the equity in their home can be to their overall financial picture.
Let me throw this number at you.
Okay.
As of Q2 of this year, total credit card debt in the U.S. is $1.14 trillion. That's a record high.
Yeah.
When you hear that number as a mortgage loan originator, what comes to mind?
Responsibility. As a lender, we can help them. We can help our clients understand that we can use the tool of the equity they have in their home to help with some of their credit card debt, to get them out of the 35% interest payment into using, even if the rate's a little bit higher than what they had before, and using that to lower their total monthly expenses.
And that ties into, the market that we've seen over these last 4 years or so. And you know where I'm going with this. There are so many people during 2020 and 2021 who refied and got a mortgage rate in the 2s or the 3s, and now they're at a point where they never want to touch that rate, and yet they have thousands and sometimes tens of thousands of dollars of credit card debt because they've been spending too much, because inflation has been a very real thing. How do you kind of look at that picture? Clients that have a very low mortgage rate, but also they have a lot of credit card debt racked up.
Yeah, I think it's really important to really drive home the payments. Like, we see all the payments on the credit report. You owe $200 to Discover, and it's $300 a month to Capital One, and so on and so forth. And even though the mortgage might be $2,000 a month, and you have all these other payments on your credit cards, say, okay, well, let's talk about your monthly expenses, your monthly budget. This is the thing that people feel. That's the deduction you see in your checking account, right? You see $200 go to Discover. You see $300 go to Capital One, $2,000 a month go to your mortgage payment. Well, what if you only had that mortgage payment, and maybe the mortgage payment is $2,200, but the credit card payments go away because we've been able to cash out refi that mortgage. Even if it's a slightly higher interest rate than what they have now, they're still saving hundreds of dollars a month, potentially.
You're having these conversations with your borrowers.
Definitely.
What is it like when you are able to open their eyes to exactly what you were just talking about, focusing on what's coming out of your account every month versus what kind of rate you have?
It's still a hard conversation. Like, I think people have such a hard time getting past but I have this low interest rate and it's so good for my mortgage. And that's true. I don't want to tell people that that's not true. It's very true. And a 2.5% or a 3% rate feels really nice, but I would challenge people to do their due diligence and dig through, what is your interest rate on your credit card? Is it 35%? Is it 25%? Like, there's a little number on your credit card statement that's like, if you make your minimum payments, it's going to take you maybe 15 years to pay off this credit card of $10,000, $15,000. And that is it's sickening, honestly. It's tough to palate that information as a consumer, let alone as a lender, when we have a fiduciary responsibility to our clients to help them be in a better financial position.
Yeah, you and I were talking about this before the interview. Everybody seems to know exactly what their mortgage rate is, but hardly anybody knows what their credit card rate is.
No, they don't know anything really about what their credit card rate might be. And I'm going to be really honest with you. Like, my daily credit card, I couldn't tell you what the interest rate is. No clue. I'm just as guilty of it. So it's like one of those things that people kind of just are like, well, my payment, again, driving back to the payment, that's what they're concerned about. When I was in the car business many, many lifetimes ago, people come in, I want a $250 a month car payment. Well, that's what people are focused on. They're focused on their well-being. They're focused on their financial picture of what their monthly expenses are for the most part. If, they're not in a financial position to be a bit more savvy with their money, which a lot of people aren't.
So when you sit down with a borrower and you're going to help them determine if they are a good fit to do a debt consolidation loan, what factors are you looking at? What questions are you asking them?
I really want to find out I want to know what their short-term goals are and their long-term goals. Like, how old are their kids? Are they trying to send them to college? Are they trying to pay for diapers? Are they future planning for, an aging parent to live with them, or buy them a home, or plan a child's wedding, or plan their own wedding, right? Like, they've just gotten engaged and they bought a house together while they were dating, and now they're planning a wedding and moving forward, and we want to have a baby, and like all the things. And making sure that I have a very clear picture about what their goals are and how I can back them into that. Like, I had a guy the other day, I'm doing a cash out refi for him, and FHA actually was a better option for what he wanted to do, better interest rate. And we looked through his debts. We're paying off a car, actually. We're paying off a big credit card. And he said, I don't want to pay off this other credit card, even though the payment's a little higher, because I have 0% interest for the next 18 months. I go, cool, awesome. Leave it out. That's fine. If that one's not hurting your goals over the next 18 months, let's leave it be. And that's what we did.
It's interesting, listening to you talk about the unforeseen things, like what if your parent gets sick? What if something happens to you or your spouse and you need money for that? And then, you also look at the last couple of years and kind of the COVID effect, where people start living for the now because tomorrow's not promised, and they start taking vacations that they wanted to take. And, we'll think about, that later. Let's just charge it to a credit card. Also the fact that people are draining their 401ks. They aren't setting aside enough for retirement. I mean, all of these things coming together. And then you, as a mortgage loan originator, I mean, what role do you think you and other MLOs have in assessing someone's entire financial picture?
I think we have a huge excuse me, I think we have a huge responsibility. I think our role is the role that we play is like overall picture. We have the knowledge, the tools to equip our buyers with the potentially one of the biggest financial investments that they currently have in their hands. Like you said, they're draining their 401ks, they're going on those vacations, and then I come along and I'm like, hey, the market has shifted enough that you have $100,000 of equity in your house, you have $50,000 of equity in your house, and we can get, shameless plug for the AVM tool, House Canary, on a UWM site, but I use that a lot to help show the client, like, potentially you have the equity right here. Here's a range, here's some comps that have just sold in your area, and giving them that information so they're like, oh wow, like I didn't realize I was sitting on that much money, and giving them permission to dream about financial freedom, I think is one of the biggest parts of our job.
And all the while, despite all the things I just said, home values are up. Home values are up,
continuing to go up.
Yeah, and people may not realize how much equity they have in their home. And then that brings us to the subject of, okay, do you look at equity as quote unquote fake money or real money? Where do you stand on that?
I think that's a great question.
Because some people will say And you know where I'm going with this.
Yeah.
If they've got, say, $150,000 in equity in their home, they're like, oh, that's my money. I don't want to touch that. But is that really your money?
The market kind of tells you what your money is, right? Like, it might be $150,000 today. It could be $130,000 next month. Like, depends on what your neighbor sold for down the street. And did your dog ruin your kitchen floors? Like, we don't, like, it's so hard to say. Like, I think I might be on a little bit of a sliding scale. I think that equity is real money, but it should be used as a tool. I don't agree with the sentiment, and maybe this is an unpopular opinion, but as a loan officer and as a human, generally speaking, I don't agree with the sentiment. I'm just going to sit on it and let my equity grow, because it might not. It might absolutely not grow. It's a gamble that people are taking.
Yeah, it's a good point. Let me ask you this for investor clients, and I know this is one that you feel strongly about as well.
I do.
How can they leverage their equity?
I think this is such a good question, and I think it's missed a little bit by loan officers, and I don't want to offend anybody because I know there's a lot of brilliant loan officers out there, but a lot of these investors, especially during COVID, they took out these hard money loans or fix and flip loans. Like, I myself purchased a home. The contractor renovated the whole house and did all this hard money, and he was just keeping his guys busy during COVID. And so we have a lot of these scenarios with these hard money and fix and flip loans, like, they're coming due if they're not due already. And these people are, maybe these investors are scrambling to get them paid back, so they're not stuck with renewing them, or 15% interest, which is a huge number when you're talking about, especially if you do the fix and flip option where you're like, okay, I bought the property for $100,000, I put $200,000 into it. Now I am sitting on 15% interest on $300,000, and it's due and payable in full in 8 months after the renovation is done, or whatever the terms are. And we have an ability to come in and say, hey, I have these investment products. There's a vast array of options for you. I'm going to give you a 30-year fix. We're going to cash out your equity. Your ROI is going to be really good. Your investment numbers are going to look really good. And you're able to just settle your expenses and lock all that down and still get the money that you need, and maybe plus some. Maybe the equity, because of increasing markets, there's more equity than they anticipated. They can pay off their hard money, pay off their fix and flip loan, and then take the additional $20,000, $30,000, buy another investment property, continue to build a portfolio with the equity that they earned in the previous project.
And get to a point where you're cash flowing your investment properties.
Flowing. Yeah. A 30-year fixed option on an investment property, especially one that you have to show zero income tax for, like, that's very attractive to them. And if you're having these good conversations with investors, it opens up a huge piece of the industry for us as loan officers to capture a bit more business for our pipeline.
What about people who are willing to refinance? They want to take advantage of that equity and maybe, get their debts to a better place. But then they say to you, Ann, you know what? I think I want to wait until rates come down. Mm-hmm. What do you say to them?
It's a hard argument to have because there's so many unknown things happening in the world right now, right? Like, we have a pending election, we have the Fed is meeting in a couple of weeks, and we just don't exactly know how things are going to shake out. And it is a really hard conversation. Like, if I try to take off my loan officer hat and be very empathetic to how they're feeling, and do my best to be as empathetic as possible, and just have a real human conversation with them. Like, hey, Justin, I hear you. I understand that you might feel like this is going to be a better option for you moving forward. I can't guarantee it, though. I don't know what's going to happen. And kind of help drive them back to, but what I do know right now is I can save you this money. I can give you this scenario. I can help you, use your equity as a tool to better your financial position. And maybe it's a 6-month option. Why don't we do this now? And in 6 months, let's look at it again. Maybe 8 months, maybe on the anniversary of your refi, maybe this time next year, let's look at it again. And maybe we've given the market enough time to settle and rates have come down even more, and you'll be in an even better position then as well. I think that that's a really good option for them to take advantage of the known versus gambling, throwing, all your chips down on black and hoping for the best.
Yeah, you're right. It's a great point. That a lot of this is just a huge gamble, and no one has a crystal ball. As much as we would like to say we know what's going to happen.
I'm sure there's many humans much smarter than me that know, they probably can forecast a little bit better about what's going to happen. But when I'm just talking to Justin, the homeowner, it's like, I don't know what's going to happen, but I know that I can help you right now.
Exactly. You and I were talking about this too, that, the refi world that we're in now, and we're finally to a point where we're getting into that refi boom. It's totally different than it was 3 to 4 years ago. And a lot of loan officers got into the business during that time. Mm-hmm. How is it different now versus then, and how can LOs take advantage of it now?
Yeah, I love this question. I kind of thought about this the other day, and a lot of loan officers that got in during COVID, selling a refi at 2.25 is not terribly difficult. You're like, hey, do you want to come down from 5% to 2.25? Yes, sign me up. You structure the refinance, the loan structure is a little bit different, but now kind of like what we've been talking about, like we have to be able to say, okay, well, your interest rate's 8% or it's 7%. I'm going to take you down to maybe 7%. And leveraging some of that equity, we're going to pay off some of these credit cards, or maybe we're just going to do a rate and term, and I'm going to save you $80 a month, but I'm going to reduce your mortgage insurance because the market has improved. Or something that I've really kind of been excited to talk to clients about is like, because you do have a better equity position in your house, maybe we tackle the single premium mortgage insurance. Let's buy it out. Let's finance in that mortgage insurance, get rid of it out of the payment. It starts to get really attractive around 15% equity, 10% equity. And talking to them about, hey, I'm going to remove this part of the payment. I'm going to remove the mortgage insurance. I'm going to help you understand what it looks like to buy your interest rate down with points, and let's finance that in a little bit too. I'm going to have you pay for your appraisal. That's awesome. I might refund it for you at closing. However I can structure that for the client to make it really appealing for their big financial picture. That's how we have to start talking to our clients about these refinances now versus I have a 2.5% interest rate, go. That's not a conversation anymore. I wish it was.
Yeah, and you just said it, the entire financial picture. And it seems like now more than ever, there's an opportunity for mortgage brokers, for LOs to really solidify their positions as true advisors and not just somebody who originates loans. So if you're talking to all of the LOs, all of the brokers out there about that opportunity, what is your message to them?
Be patient. Be patient with your clients. I'm preaching to myself mostly.
So you're talking to yourself.
I am
not
talking
just
to
else.
myself. Yeah. As a loan officer, as a go, get it done kind of personality, I am definitely talking to myself, but be patient with your clients and be prepared to have those conversations with them. Like, it isn't as easy of a conversation anymore. Like, we do have to be very knowledgeable. Like, you're sitting down looking at the whole client's, financial picture and jot down the notes, like get to know them. Like, hey, did they put dependents in their dependent line? Like, oh yeah, forgot little Johnny. He was 6 last year when they closed. Now he's 7. He's probably going into I don't know, do they do first grade or second grade at 7? But he's in elementary school, and how is back to school? Like, what are you guys planning for? Is he starting to play? Like, asking these deeper questions and giving yourself some more time. It's not the grip and rip refi season. It just isn't. We have to be more patient, more prepared, and just take your time with your clients to get to know them a bit better. Understanding their wants, needs, and pain points is really one of those things that is going to help solidify them to you as a loan officer and make them want to come back to you in the 6 month, 12 months when hopefully rates continue to come down to be another repeat client.
And really help paint that picture too of how powerful a tool that equity is.
Yeah.
Because we talked about the credit card debt and the draining of retirement funds and unexpected things that pop up and
Yeah.
people wanting to take trips. That
Yeah.
equity you have in your home, I think a lot of people just don't understand
Yeah.
how powerful it can be.
It can be real green dollar bills in your hand. Like, if you really wanted it to be, if you wanted to come and do a cash out refi and you just want me to deposit $50,000 in your bank account after you close, cool, awesome, do you. That's great. I love that for you. If you need money for any particular reason, you don't want to do a renovation loan and you want to do some renovations to your house, let's do a cash out refi. It's probably going to be an easier process. It's going to be a better loan product. I think there's a ton of options. We could probably be here all day talking about different ways to structure and pitch it and how to talk to this customer and things that would be more attractive or more valuable to the client. But I think making sure that we are having those good financial conversations is paramount.
It's such an important topic, and obviously it extends beyond mortgages, but we are so happy to have had the opportunity to sit down with you and
Thank
talk
you.
about it. And I know that our listeners are going to take a lot away from this, and hopefully they can help their clients as well. Ann Sullivan with us from Lending Heights.
Thank you
Ann,
so
thanks for being
much.
here.
Thank you, Justin. I appreciate it.
Thank you for watching Good Better Broker and helping us support independent mortgage brokers everywhere. Be sure to subscribe to our YouTube channel to be notified about new videos, as well as your preferred podcast platform for a new episode every other Tuesday.